It begins the same way every time, with a whisper that becomes a chorus and then a roar. Prices rise, fortunes bloom, and a new story takes hold, that wealth has finally learned how to grow without risk. Then, almost overnight, the music stops. Liquidity vanishes as if someone pulled a trapdoor, and confidence, so abundant just days earlier, becomes the rarest asset on earth. The names change, the technology changes, the countries change, but the script does not. The hidden blueprint behind every financial collapse starts with belief. A new idea promises to bend the laws of finance. A faster trading system, a revolutionary commodity, a novel kind of bank, a geopolitical peace, or a monetary design that will fix the old problems. Credit expands to fuel that belief because credit is the oxygen of markets. Standards loosen, lenders multiply, and prices rise, making yesterday's risk look safe. And when the future looks both certain and profitable, the smartest people in the room start to push their luck. Underneath, the machinery is always the same. Borrowers take on debt to buy assets that seem to go up forever. Lenders lend against those same assets, confident they can be sold tomorrow to the next buyer. Collateral is pledged and repledged, a chain of promises supported by rising prices and faith in the system. The more stable it feels, the less margin for error exists. The cycle becomes tight, brittle, and beautifully arranged until one piece breaks. Economist Hyman Minsky called it the paradox of stability. The safer things appear, the riskier the system becomes. And it's not just psychology, it's structure. Reliance on short-term funding, the belief that markets will always be liquid, and the quiet assurance that central banks or governments will step in if things go wrong. This is how every boom becomes fragile. Not with a bang, but with the comfort that nothing can go wrong, until everything does. Travel back to the Dutch Republic in the 1630s, and you'll hear the same rhythm. Tulip bulbs, rare, exotic, and wrapped in stories of status, became contracts, then side bets on future deliveries. Prices soared in winter taverns as traders passed handwritten promises like currency, a market built on trust and the expectation of resale. But when doubt crept in, when a single auction failed and a few bids didn't show, the chain of confidence snapped. Over a few weeks, contracts lost their magic, and a market that seemed limitless shrank to nothing, a reminder that belief is a balance sheet all its own. In 1720, John Law brought modern finance to Paris and set the stage for another act in the recurring drama. His bank issued paper money backed by faith in trade, and shares in the Mississippi Company promised a fortune from a vast new world. Prices rose, debt piled higher, and Paris invented the spectacle of a crowd chasing wealth in the streets. But when investors tried to turn shares back into gold, the promise couldn't be kept at scale. Panic followed. The same blueprint, the same frantic search for cash, mirrored that year in London's South Sea bubble, where a clever swap of government debt for equity ended with the public holding bags instead of riches. By the 1820s, Britain was the financial center of the world, and its investors poured money into the young republics of Latin America. Bonds for mines that didn't exist were sold with glossy brochures and glowing testimonies. When commodity prices softened and remittances slowed, the market turned. The Bank of England quietly lent to keep solvent players afloat, but the lesson was clear. Global capital booms become global capital busts. 4 decades later, in 1866, the collapse of Overend, Gurney & Co., a major London finance house, replayed the panic with a new cast, pushing the bank toward a doctrine that would shape the modern era. Lend freely against good collateral at a penalty rate to save the system from itself. Across the Atlantic in 1873, railroads were the internet of the age, high growth, high promise, and financed with mountains of debt. When J. Cook and Company failed, the shock ricocheted through banks and bond markets. Projects were halted mid-track, workers were sent home, prices fell in a slow grind that historians call the Long Depression. There was no quick rescue, no central bank with a powerful fire hose. The same script played out in slow motion, with the world learning how painfully long a downturn can last when liquidity dries up and debts refuse to shrink. In 1907, the catalyst was a failed attempt to corner the market in copper. Trust companies in New York, lightly regulated and built on public confidence, saw depositors line up around the block. With no central bank, one man, J.P. Morgan, jammed a solution through sheer force of will, locking bankers in his library until they agreed to backstop the system. Clearinghouse certificates, IOUs among banks, passed for money until calm returned. Out of the panic came a revelation. The United States needed a lender of last resort, and 6 years later, the Federal Reserve was born. By 1929, euphoria had a new engine, cheap margin loans that let ordinary people buy stocks with as little as 10% down. Brokers' loans skyrocketed. Speculation became a national pastime. And the story of easy money filled the air. When the market broke, margin calls turned investors into forced sellers, and forced sellers became a stampede. Banks failed by the thousands, credit shrank, and trade collapsed, magnified by policy errors, the straitjacket of the gold standard, and a global rush to hoard cash. It took years, new laws, and the creation of deposit insurance to rebuild trust. The blueprint evolved with policy. In 1971, the last link to gold snapped, and a new era of floating currencies and oil shocks arrived. The 1973-74 bear market cut stocks in half as inflation and recession collided, and banks spent the late 1970s lending heavily to emerging nations. By 1982, high interest rates, deployed to finally crush inflation, pushed Latin American borrowers to the brink, and the debt crisis flared. Again, the story was familiar. Loans made during the good times turn toxic when the price of money rises and growth stalls. Then came 1987, Black Monday, when the Dow plunged 22.6% in a single trading day. This wasn't a recessionary bust, it was a structural failure in market plumbing. Portfolio insurance, a fashionable strategy that used selling to limit losses, set off a chain reaction of more selling. Liquidity vanished as buyers stepped back, revealing how thin the market was at the worst possible moment. The Federal Reserve's swift promise to provide liquidity calmed the panic and signaled something new, a central bank willing to reassure markets even when the real economy wasn't collapsing. In 1997, money surged into Southeast Asia, where growth was fast, currencies were pegged to the dollar, and debts were short-term. When confidence cracked, capital fled, exchange rates tumbled, and companies that owed dollars couldn't repay. The Asian financial crisis forced devaluations and IMF rescues, with austerity biting hard. A year later, Russia's default stunned investors and nearly sank long-term capital management, a hedge fund whose elegant models masked extreme leverage. The Fed brokered a private rescue to prevent a wider meltdown, another iteration of the Blueprint's Rescue Act. The dot-com era took the same pattern and wrapped it in the optimism of a new age. The internet would rewrite commerce, and in time it did, but not before a fever drove prices far beyond profits and business models. When the bubble burst, trillions in paper wealth vanished and investment dried up. The response, massive interest rate cuts, kept the economy from deep recession. But it also planted the seeds for the next chapter. Cheaper money flowed into housing, and the story shifted from code to concrete. The 2008 crisis is the blueprint's modern high watermark. Mortgages were sliced into securities, layered into collateralized debt, and insured with credit default swaps that made risk look invisible. Wall Street created shadow banks that borrowed short and lent long, betting that money markets would never say no. When home prices stopped rising, defaults rose, and collateral shrank, the chain reaction began. Bear Stearns fell, Lehman Brothers failed, AIG imploded, and a run on the shadow system forced the government to deploy massive guarantees, TARP funds, and unprecedented central bank programs to keep the pipes from freezing. Europe learned the script in its own currency. The euro-bound nations under one central bank but left fiscal policy fractured, and local banks stuffed themselves with their own government's bonds. When Greece admitted its deficits were larger than reported, mistrust spread to Portugal, Ireland, Spain, and Italy. Yields soared, economies contracted, and the feedback loop between shaky banks and shaky sovereigns deepened the crisis. Only when the European Central Bank promised to do whatever it takes and backed it with a program to support sovereign debt did the storm begin to fade. And then the shock that tested the system in a new way, a pandemic. In early 2020, the world shut down and markets experienced the fastest 30% drop in modern history, not because assets were worthless, but because everyone needed cash all at once. Even the US Treasury market, the deepest of all, wobbled under the strain as investors tried to unload everything. Central banks responded with overwhelming force, backstopping corporate bonds, stabilizing money markets, and flooding the system with liquidity. The aftermath was another familiar arc, a surge of speculation, SPACs, meme stocks, crypto, and then the come down as inflation returned. Rates rose and weak links snapped, from the UK pension fund spiral in 2022 to US regional bank runs in 2023. Look closely at each moment, and the turning points are uncannily alike. First, the story cracks. A failed auction, a missed payment, a policy surprise, a rumor that lands just right. Second, collateral, once taken as gospel, loses value, and lenders call in loans to protect themselves. Third, liquidity evaporates as everyone races for the same narrow exits. Fire sales beget more fire sales. Losses leap across balance sheets, and fear spreads faster than facts. The panic stops, not when the last skeptic is convinced, but when the marginal seller runs out of things to sell, or a backstop appears strong enough to be believed. The second set of turning points belongs to policymakers. In 1907, a private banker played lender of last resort. In the 1930s, the central bank moved too slowly, and the collapse deepened. In 2008 and 2020, central banks and treasuries moved faster and larger, learning Begehat's old lesson, lend freely against good collateral at a penalty rate, but adapt it to a world where the run happens in money market funds, repo markets, or even ETFs. Each rescue stabilizes the present, but it also imprints a new expectation. that someone will always catch the system before it hits the ground. That expectation can steady the stage or set the next act. The consequences are never just numbers on a screen. They are lost jobs, shuttered shops, foreclosed homes, and dashed plans deferred into an uncertain future. They shape politics, fuel populism, and rewire public trust in institutions. They also change the plumbing of finance. Deposit insurance in the 1930s, deregulation in the 1980s, Basel capital rules and stress tests after 2008, and liquidity backstops designed in the last few years. Yet regulation often squeezes risk from one corner only to watch it ooze into another, more shadowy space. The blueprint adapts because financial systems and human ambition are adaptive too. Globally, these cycles reallocate power. Countries that absorb capital inflows too easily often suffer the hardest reversals. Those with credible institutions and deep markets become safe harbors with privileges that look like destiny. But even safe harbors can roil. A sudden shortage of dollars, a shock to energy, a war in a key region can knock the world off balance. The market learns, the market forgets, and the market relearns. Each time with more complexity, more speed, and more eyes watching the same screens. The deepest impact is psychological. After every bust, a generation loses its appetite for risk until the next generation, unscarred, arrives to try again. So, what does the blueprint tell us about now? It tells us to watch the spreaders of credit, especially outside traditional banks. Private credit funds have grown into a multi-trillion-dollar lending machine. The risks they take are not as visible as bank balance sheets. Corporate debt has been refinanced at low rates that must roll over in a higher rate world. And collateral values, from commercial offices to speculative tech, will be tested. In markets once thought unshakable, like government bonds, leveraged strategies can create hidden fragility, as the UK learned when pension funds were forced into fire sales. And in digital finance, where crypto and stablecoins promise liquidity on command, the old truth still holds. When everyone asks for their money back at once, only one thing matters: who holds the cash? The blueprint also teaches humility about narratives. Artificial intelligence may remake productivity, just as railroads and the internet did. But even great revolutions invite great speculations. Geopolitics can flip the calculus of risk in a day, altering supply chains, energy flows, and capital routes. Climate events and insurance costs can turn local hazards into systemic ones when maps are redrawn and models fail. And while central banks have new tools, they face a harder test: taming inflation, sustaining growth, and guarding stability in a world where faith can dissolve at the speed of a notification. The rescues may keep coming. The trade-off between moral hazard and catastrophe will keep getting sharper. What breaks the script is not better math, but better memory. Systems that remember their own fragility, build buffers in good times, resist the lure of easy leverage, and design backstops that don't invite reckless bets. Investors who remember look through new stories to the old mechanics: cash flow over hype, debt terms over dreams, exit liquidity over entry fantasy. And citizens who remember ask wiser questions. Not just how much can we gain, but how will this behave when the tide goes out? Memory can't stop a cycle, but it can soften the landing. For all its drama, the blueprint is a map, not a prophecy. It shows the points where the ground tends to give way, the paths that lead to panic, and the routes that lead out again. It reminds us that finance is a confidence game, in the most literal sense, a web of promises that only works when most people believe most of them, most of the time. There will be more booms, there will be more busts, there will be more declarations that this time is different. And somewhere, in the quiet before the crack, someone will notice that it sounds like a tune they've heard before. In the end, every collapse follows the same script because every boom begins with the same line: trust me.